Hi, good evening, everyone, and a warm welcome to our LOF Let's Learn Futures webinar series. We are thrilled to have each of you here with us today. And before we begin, please confirm in the chat box by typing a yes or 111 or even share an emoticon if you can hear me clearly. If you're able to hear my voice and see my slides, can you type in yes or type in 111 in the chat box so that I know everything is well on your side? Great, thank you very much. I appreciate that. Now, today's topic is 3 comprehensive trading techniques for crude palm oil futures. This LLF webinar series is proudly presented by Bursa Malaysia in collaboration with our company Excellent. I'm CY So, your moderator for today's session. We are privileged to have David Ng joining us to share about what are the 3 techniques you can use to trade the crude palm oil futures. I see more people have just joined the webinar room. Welcome. Once again, before we begin, let's do one final sound check. Please type in 222 or yes in the chat box if you can hear me clearly. And if needed, please adjust your volume settings to ensure optimal sound quality. To ensure you have the smoothest and highest quality video experience, I highly recommend turning off your video camera during the session, as this will ensure that everyone can enjoy uninterrupted webinar and have an optimal learning experience. Today's session will be divided into 2 parts. In the first part, David will present his sharing. Following that, we will be having a Q&A session where you can ask any questions related to today's webinar topic. And to ensure we can address your questions effectively, please follow these few steps. Firstly, I believe you are able to find where is the Q&A section below. And once you click that Q&A button, make sure that you can type in your questions there and make sure it is sent to all co-hosts. And please note that due to the high volume of messages in the chat box, it may be challenging for me to spot your questions if you don't use the Q&A box. So feel free to type your questions in the Q&A box at any time during the presentation. As this LLF Let's Learn Futures webinar series is brought to you by Bursa Malaysia, we have lined up of exciting topics ahead. So every Tuesday, we will host new webinar in this series featuring sessions in English, Malay, and Mandarin. Our panel of speakers will share valuable insights and practical strategies related to futures trading. We have many content-packed and informative topics lined up, with more being added regularly. If you're interested in enhancing your knowledge and skills in futures trading, you can simply scan this QR code to register. And don't forget to add these sessions to your calendar so you won't miss any of them. In addition to the LLF webinar series, we also offer the LLF online workshop. Now, this online workshop is different from the webinar as it is specially designed for those of you who are new to futures trading. In these workshops, we cover a full set of beginner's knowledge in futures trading. It's a step-by-step guide to help you kickstart your first futures contract, and each session is 3 hours long. So if you're new to futures trading and would like to learn more, you can register for these online workshops. They are entirely free and fully sponsored by Bursa Malaysia. And please note that the attendance is limited to the first 50 online participants. So be sure to grab your seats quickly. Before we begin, it's my pleasure to introduce our speaker for today, David Ng. Now, with years of experience in the derivatives industry, David is a seasoned expert in this field. And previously, he served as the head of marketing at Philip Futures, where he led the team in driving growth and development in the derivatives market. Currently, David is a full-time proprietary trader with Iceberg X, which is a local proprietary trading firm. And today, he brings a wealth of knowledge and experience to our session today, and we are thrilled to have him share his insights on today's topic. So without further ado, I'm delighted to hand over the presentation to David. And David, the floor is yours.
Okay, thank you, Siwai. Firstly, just like to thank Excellent as well as Bursa Malaysia for inviting me to speak on this topic, entitled 3 comprehensive trading techniques to trade the crude palm oil futures. So I believe we have a mix of audience that that's joining us tonight. mainly your background, whether it's trading trading full time or part time, or you're new to the futures market. I believe hopefully that this webinar will probably enrich you in certain information that you need prior to actually embarking on journey to trade the futures market. As probably you probably could have seen the market in the past couple of days, actually been a very volatile session. Be it whether you are in the equity space, the equities market, or even the commodities like the CPO, we have seen dramatic volatility across the board. So I think this is an opportune time. If you can get the trend right, when market is volatile, there's always an opportunity for traders to really capitalize when market move in such an erratic manner. So I'm just going to share three simple ways to look at trading the CPO market. I think firstly is to look at things on a fundamental perspective. Secondly is to look at things on a technical point of view, because technical will always be making entries and exit more precise. And last but not least, I just like to share on minimizing a risk by using a spread trading strategies that you can probably use to enhance your way to trade the market. So as usual, I think before I start, just to disclaim myself, I think materials presented here today is basically purely for educational purpose, and any opinions reflected today is purely based on my own personal opinion. It doesn't reflect whether it's the opinion from the organizers or whether it's the opinion from the exchange. And I do highly encourage you, if you are new to the futures market, make sure you do consult a licensed representative. There's a lot of licensed brokers, an futures institution that you can actually, seek their advice. They are all listed on Bursa Malaysia website. Do have a look at it. So before you embark, make sure you're well educated. Engage with a licensed representative. And dabbling in futures market is definitely full of risk. So make sure you're well aware of the risk before you take the plunge. So I think this is the agenda that we're going to cover in the next hour or so. I think firstly is to look at, whenever we talk about palm oil market, palm oil is definitely heavily traded in the Malaysia space. It's one of the, we always pride ourselves in terms of the Bursa Malaysia palm oil contract as being the benchmark in global pricing. So around the world, whenever we talk about palm oil, they always look at the Bursa Malaysia palm oil prices. I think in our local commodity scene, I think palm oil is heavily and popularly traded. So it's therefore fair enough to actually have a look at it. And I think when you trade the market, it's also good to gauge things on a fundamental perspective. Now, be it as in any other commodities, fundamentals usually play quite a crucial role. And I'm just going to share with you some of the key things to look at, especially when you look at what moves prices, what are the factors that actually underlie or underpin certain price movement when it comes to the palm oil market. Now, I think when it comes to commodities, if you're trading commodities in general, whether it's palm oil or whether you talk about the rest of other commodities like grains, the US grains market, I think seasonality to a certain extent does play a role. And you notice that there's always a period in time or period of the year where the price have a tendency to react in certain manner. We have seen that across many years. So in certain ways, commodities are quite seasonal. There's always a period of time where prices tend to be stronger. There's always a period of time where prices tend to be weaker. Now, in those instances and those periods, it's a good opportunity for actually traders to try to capitalize based on the seasonality impact. But do keep in mind, seasonality always have a shortfall. There be a times where this probably be a time of year where it won't follow the historical seasonal pattern. It does happen. It also tend to happen. So therefore, I think we have to use with a pin of short. Seasonality does help us in terms of gauging where the market may go, but it may not be a cause for where the market is heading to. Now, I think last but not least, looking at things on a technical perspective will give an edge in terms of looking at entry levels and exit levels where we should put our stop loss. Now, markets are very volatile. If you've seen how the markets reacted, yesterday and probably today as well, you can see that without a proper risk management in place, you probably can get stopped out quite easily. So having a proper risk management is vital, especially when we are facing a volatile market situation like what we are seeing right now. So with that, I'm just going to share with you a simple methods that you can use whenever, or you can employ whenever you look at your trading strategy. And importantly, is always make sure you have a stop loss or risk management in place, because that will ensure that you are able to take the next trade without much of a harm. So I think crucially, as a trader, if you're doing this full time, it's important for you to make sure that you measure your risk accordingly. And in every trading strategy that you use, it's important to have a mindset that a risk parameter must be set before taking any trades. So I think firstly, just to give a very brief introduction to the palm oil market, or rather the futures market. So if you are someone new to futures, so futures is definitely if you just look at a technical definition, it's talking about a contract agreement that is between both two parties. Now, if you look at how the market is, how the derivatives market is being run, you can clearly see that every palm oil contract is very standardized. So if you are a buyer or a seller, you are buying a fixed quantity, a fixed quality of a particular contract that's being stated or stipulated beforehand. So a lot of, whether you're in a business of doing palm oil business, a lot of people will go to the futures market to hedge their risk because of the nature that is a very standardized contract. So in that sense, it's easier to trade. Now, there's always other type of arrangement you can do. That's what comes into forward agreements or forward contracts. I'm not going to go too much in that. But what is the main focus is futures contract ultimately is a very standardized contract. So if you look at CPO contracts, it's a very standardized contract. Every contract is 25 metric tons. So it's standardized in that way. In the quantity and the quality of the contract itself, is each and every contract is the same. So it gives a kind of assurance that if you are in the business of buying and selling palm oil, you have assurance of the quality. You also have the assurance of quantity. So in that way, it facilitates your trade. Now, a lot of people say, why use futures market? Now, if you are in the palm oil business, if you notice that futures market involve a lot of contracts, you have contracts right up to a year forward. So you can probably trade 2025 future prices, which is probably, you'll be asking yourself, how can you get that kind of price? There'll be always a willing buyer and a willing seller in the market. With that, there's a price discovery. So futures market, in a sense, helps you to discover prices. So if you're someone in the business of buying and selling palm oil, hedging is an important thing for you. Futures market is the perfect place for you to be, transacting or doing your transactions. Now, for us, or rather the majority of us, we are mainly the speculators. That means we are someone that is in the market for reasons to gain profit, and with that, our role is to speculate the direction of the market. Now, BMD, Bursa Malaysia palm oil market is highly liquid, so there's no issue. Futures contract ultimately is governed by the exchange. In this case, it's Bursa Malaysia, and every contract is being honored in a way, and there's an expiry to a certain. Every contract has an expiry to it, attached to it. So in a sense that it is very standardized, very quantifiable, and therefore it makes it easier to trade. Now here's basically a contract specification for the palm oil contract. You can clearly see that every contract is 25 metric ton. And the good thing about it is that, if you look at BMD, Bursa Malaysia futures contract, you can see that there's a lot of month being listed. Future contracts being listed. It's up to at least 2 to 3 years forward. Now, in that sense, it allows a lot of users, especially in the industry, to really go to the market and hedge their risk. And therefore, it actually helps, with participation from the hedgers, from the speculators, it creates vibrancy. The vibrancy of the market will be dynamic. So therefore, I think BMD is in itself is a price benchmark for the world. Now, trading hours are between 10:30 to 12:30 of first session and 2:30 to 6 p.m. Now, with the introduction of the T+1, which is a night session, it starts from 9 p.m. to 11:30 p.m. The night sessions are also very useful. So in case you're having positions that they tend to you couldn't close during the morning or afternoon session, you can probably close it at night. And given that now international markets are trading, especially the US soybean oil, which is actually very relevant if you're trading a palm oil market. Now you can react to those kind of movements because you're opening at a time where soybean oil tends to be more active, which usually happens at night. So it gives a lot of with extended hours, it gives a lot of ways for traders to really maneuver the market, and there's no limitation or timing itself. Now, this is what I meant. You look at the liquidity of the palm oil market itself, the futures market. This is on the 3rd month active futures contract. You can see that the daily average volume is probably about 35 to 40,000 contracts. That is only for the active month. We haven't included the other private months or other forward months as well. So you can see that the market is actually indeed very liquid. The slippage of it is actually very minimal. So and over the years we have seen the average daily volume continue to increase. This is also mainly due to heavier participation from a lot of other international participants as well. So in natural effect, I think this is increasing the overall volume in the market, and therefore it's actually increasing the vibrancy of the market itself as a whole. Now, I'm just going to share you a very simple way to look at calculation of profit and loss dynamics on using this futures BMD futures CPO contract. So you can clearly see this is latest chart I gathered from the BMD palm oil contract. You can see that price indeed. No, I think this was before the plunge. Price was actually trading on a very tight channel between the 3,900 and 3,800 support and resistance level. And it finally broke that up, I think, in the early part of last month. And I think once the price breakout, normally it entails that the price is going to go for a new rally. No, so this usually be an opportunity for a lot of traders to find that when price breakout, there's a good setup, a good trade setup, and for that to actually capitalize such an opportunity. So just to give a scenario on how to calculate the profit and loss. So in this scenario, you saw a breakout from a very long channel market. So it's a good opportunity for you to long. So imagine that you long a contract at 3,990. So the margin for one lot is 7,000. Keep in mind, margins are adjustable on a quite regular basis. Normally, you do have to check with the brokers. The brokers will inform you accordingly once there's a change in your margins. Now, margin requirements are important to take note because once exchange regulate the margin requirements, it will affect your liquidity ratio, or it affect whether you have margin call or not. So importantly is to make sure you adjust your risk and your margin accordingly. Don't be over margin, and you also can't have too much buffer. So keep your margin at optimum level. But most importantly, always make sure you keep sufficient margin just in case when market go against you. You don't be driven by a margin call. So in this example, if you are taking a long position for the fact that you look at a chart wise, technically is doing a breakout trade, and you're long at 39.90 and the market went to 40.20, it's a good position that I think, hey, market went up. You expect the market to go up and the market did went up. So in this scenario, actually you're making money. So how do you calculate the profit? Is simple. You take the price that you come out, which is about 40.20, you minus the price that entered 39.90. You got price differential of about 30 ringgit. Now, the tick value for CPO for one tick is 25 ringgit. So in this case, you got a 30 ticks. That means you make a profit of 750 ringgit in terms of value wise. So that's how you calculate profit. Now in market doesn't always, in every trade, it's not always 100% guarantee a success. There's always trades that you don't make money. Now that's fair. It's pretty much bread and butter of the trading business. So in this example, if let's say you're thinking that a market it show a breakout and you're thinking that's a good long position, and you took a long position at 39.90, same margin requirements, and the market, you expect the market to go higher, but the market didn't, even lower, even to 39.50, and you think that, oh, the market is against me, I think it's better, and I reached to a point where I only can take this amount of loss, I have to get out. So the way to calculate your loss is you take 39.90 minus 39.50, talk about 40 ringgit differential or 40 ticks. So it times the tick value of 25 ringgit. So that gives you a loss of 1,000 ringgit. So again, this will be measured against your margin. So you must have a sufficient margin buffer in your account to make sure that you don't get frequent margin calls. Your brokers will probably call you to encourage you to top up. And as a trader, you always dread margin call, because whenever the brokers call you to top up margins, that usually tells you that usually your positions are against the market. And that usually be a good time for you to reassess your positions, and it's good time for you to be out of the market. Now, so that's simple illustration on contract specifications and also how to calculate the profit and loss. Now, really, I think important aspect, the first thing to look at trading the CPO market is to understand the factors that affect prices. Now, in any commodities, whether you're talking about grains, you're talking about soybean oil, palm oil, in fact, supply and demand dynamics is always an important factor. Simple economics, if you have an over excess supply in the market, what happens to your price? Price will have to come down because there is too much of supply. Vice versa, if you have a very small supply but demand is strong, normally that will push prices higher. So CPO is no different. CPO is mainly driven by also supply and demand dynamics. So it's important for us to take note. The key important factor to really look at in the CPO market is when it comes to fundamental per se, is to look at the supply and demand factor that's in play. Now, there's other external factors. I think one of it is definitely you can look at the soybean oil prices. Now, if you've been trading palm oil, you notice that soybean oil and palm oil are highly relatable. Whenever soybean oil is going up, you probably could see palm oil prices to follow suit. And when soybean oil prices are weak, you probably could see palm oil prices also tend to be weak. So soybean oil and palm oil are like brothers and sisters. They are very correlated together. So if you are trading palm oil, you need to see where soybean oil performance is as well. Now, other measures like weather is an important factor. Even ringgit performance is also having a bit of factor when it comes to CPO prices. Government policies. Now, among all these factors, which is highly unpredictable, is definitely weather. We can't predict weather. As good as what our weather model says, sometimes they do get it wrong as well. And now we know whether we blame it on climate change or not, weather phenomena is getting erratic. And when this happens, usually it will affect supply. So that is something that if you're trading a market, we need to be very aware of and careful. Now, government policies are also very unpredictable. We have seen that in a couple of instances. I'm going to share later on the slides. And biodiesel demand is also one strong factor that actually link crude oil prices with CPO prices. So if you have strong oil price environment, normally it usually entails stronger CPO prices because CPO is also used as a feedstock for biodiesel. And when you have high oil price, there's more incentive for people to blend palm oil with crude oil as a way to manage their finances. So biodiesel demand is very visible in how to relate the crude oil market with the palm oil market. Now, palm oil is definitely a major commodity for our country. If you look at it in terms of the top producers, we are actually easily second. We used to be first. I think Indonesia overtook us back in the early 2000s. And I think since then, there's a big gap between Indonesia and Malaysia production. But nevertheless, we still maintain a second spot. So both Indonesia and Malaysia contribute more than 50% of the global total palm oil production. So therefore, Malaysia is a very significant player when it comes to the palm oil market. Now, exports are also equally, we are also the second largest in terms of palm oil exports, being we are the second largest in terms of producing palm oil. So crucial, I think, to watch is that countries that demand a lot of palm oil from us is mainly China and India. Now, as economy grows, there's more demand. If China economies grow, usually that means strong demand. So these are the factors that we should watch out if you're looking at the general palm oil market. Now, when you look at palm oil market in general, there's a lot of reports that usually come in play. Whether the brokers will send you or whether normally they send it as a monthly report. I think the key crucial report to watch out is always the Malaysia Palm Oil report, which is come out on the 10th of every month. I know it's tedious. That's why I think that's where brokers will give you as a part of a service to keep you up to date with all these reports. They will summarize it accordingly and probably give their opinion where the market is heading based on the report that's being published. But I think it's important for us to at least get a grasp on, every month we have reports, or in fact every week we have certain reports. It's very crucial to determine where the market is heading to. So every month we have the Malaysia Palm Oil report, which is on the 10th of every month. Secondly, we always have the cargo surveillance report. Now these are all very important because cargo surveillance is to tell you how's the export momentum. That usually beginning of the month we see strong momentum going into the month. A lot of export demand. Maybe China is buying, maybe it's India is buying. But towards the middle of the month or towards the month end, we start to see momentum start to fade. China demand less, then we tend to see this kind of reaction. Then prices will tend to react based on this information. So it's important for us to get a grasp on all these surveys and export estimates as we head into every week itself. We also have production surveys. I think those days it's very hard for us to obtain such information. Now I think now with technology, with with easy access of data and information. Surveys are made available quite easily. So production surveys now, usually they take it, be middle or towards the third week of the month. You tend to see where the production estimates are, and that will probably paint before the official MPOB report is out. They probably can give you an estimate as to where the production and stock levels is. These are good estimates because market will tend to react to estimates. So whenever market falls, or the actual reports fall below expectation or higher than expected, usually you see prices reaction. So in a sense that, with all this, we can gather a bit more opinion of the market, and therefore I think all these prices will tend to react based on these expectations. Now, other reports and other external reports like the USDA, which is relevant to the soybean oil and soybean market, those are also having an impact on us because eventually that will affect the soybean market, which indirectly will impact the palm oil market as well. So USDA and weather reports are also key crucial report to look at. Now, these are not very timely, and these are not very regular, especially the weather report. But when usually they tend to give reports when they're used to assess weather extremities, whereas ongoing La Nina or there's a possible El Nino occurrence, that will publish a report. And by then, I think prices will tend to react based on all these reports that's being published. So just going through some MPOB reports. Now, these are all in transparent data I can gather from Malaysia Palm Oil Board. Now you can see why palm oil is very seasonal. If you look at over the past 15 years or even 20 years, in fact, if you break down month-to-month production pattern, you can clearly see a very nice trend that's in place. You probably could see that the start of rising production usually happens in the beginning of March and April onwards. So if you are looking at months, if you are trading in a particular month, March and April, where you start to see production tend to rise, is usually where you see weaker prices. Now, this rise in production pattern would probably tend to reach its peak probably around end of October or early November. So that's where, after November almost, you start to see production pattern starts to fall off. And when production tends to decrease, if you look at normal economics, supply becomes lesser. That means there is more opportunity for you, for prices to go higher because of the short in supply. Now we have seen that in over the past 15 to 20 years. Now there is always a particular time where it doesn't follow the seasonal pattern. That's crucial for us to take note. But in over the historical pattern that we see over the years, it's quite clear that the rising production usually starts in early March and ends probably around the early part of November. So right now you can see that for this year is particular. For March and April is showing you a rising trend. The only part that is missed is that the May to June period this year seems to be a bit sluggish. Now, as we go into July, as we hit into July and August, production pattern is expected to increase. So that's the expectation of the market. Now, if reports came out and it falls below expectation, or whether production doesn't seem to pick up, that could spell a potential rally in price. So that's how we adjust expectation against the reality of the market. Now, much to say, I think if you compare production pattern against production level against CPO prices, you can clearly see one common pattern is that whenever you see rising production, normally it tells you that prices will find it difficult for it to go higher. And whenever you see production pattern tends to come down, that's where you see prices tend to be well supported. So that's the inverse relationship between CPO prices and the production pattern for the CPO market. Now, I wish to mention a lot on stocks. I think stocks is a function of your supply and demand. So if you have abundant supply and demand is not meeting the excess supply, stocks level is going to go higher. So if you look at historical pattern, the stock levels in Malaysia is probably about 2 million tons. Now, anything that's above 2 million tons is telling you that we are in a territory of high production period. Now, when anything is below 2 million, that means we are actually quite tight in supply, or rather tight in stocks. So now we have seen over the years that production pattern and the stock levels, especially after a pandemic, it was actually very short. It was staying below, I think, 2 million tons for probably about a year or so. But since then, I think stock levels are just slowly inch higher. Now, in rising stock environment or rising inventory, prices find it very difficult to move higher. Now, just to overlay this chart, you can see that stock levels against the CPO price. Whenever you see high stock levels, that tells you that CPO price is not going to go higher. Now, this is where we are. You can see that stock levels are slowly coming down. That's why CPO prices are well supported. It's a function, it's an inverse relationship. So high stocks is never good for prices. Low stocks is usually good for prices. So as long as we doesn't reach above the 2 million mark, safe to say that CPO prices are well supported. But once we breach the 2 million mark and we go higher, that means CPO prices will find it difficult to climb or to face a rally. Now, in terms of pattern, you don't see much in stock levels. Stock levels, they don't see much of a pattern. But notice this: over the years, we start to see stock levels climb easily around June period to around September and October period. This is pretty much in line in rising production. If you recall the previous slides that I have, production tend to increase around May to August or September period. So therefore, stock levels are also very similar. It tends to build up around July to October or May to October. So during this period, when you have high production, high supply period, normally that will impact prices. Now, on the export side, it's quite irregular. You don't see of a clear pattern, but I think safe to say around August, September is usually where you start to see strong demand coming from India. Reason being is because they are celebrating the Deepavali, which is usually around November period. So one or 2 months before that, normally they demand a lot of palm oil or to stock up on their stockpile. So that usually translates to higher demand. So there's a bit of seasonality when it comes to export, but it's not that clear or evident as compared to the production and the stock levels. Now, China and India are the two largest Malaysia palm oil importers. So obviously, looking at ending stocks at their port is important. You can get all this from Malaysia Palm Oil Board website or Malaysia Palm Oil Council website. They publish this on a monthly basis. So as long as inventories are high at the port, there's no reason for them to buy more palm. So right now you can see that China, stocks are actually below average. Same goes for India. That's why I think this couple of months the exports from Malaysia is strong because China and India is actually buying a lot to replenish their stock at the port. So just want to make sure that they have sufficient stocks as they head into key periods of the year. Now, that's on supply and demand dynamics. Looking at external factors, we always have to look at CPO and bean oil because I think these are what we call co-parallel or co-movement relationship between these two variables. CPO and soybean oil is actually moving quite in line and in tandem. So whenever you see high soybean oil prices, that means there will be a support for CPO prices and vice versa. Now, if you look at the recent performance of the palm oil market, it's actually been very sluggish because the bean oil market has actually been very weak. Why is that bean oil is so weak? It's because in US, there is abundance of supply of soybean coming into the market. And keep in mind, soybean is also heavily planted in South America, and their plantation or their supply is also a record supply this year. Now, with all these bearishness as in the soybean oil market, is going to affect the CPO market. So therefore, I think that's why CPO market is facing a lot of headwind this couple of days because of weakness in soybean oil is actually overflowing to the CPO market. Now, if you compare why the relationship is so coexistent, you look at the palm oil and bean oil relationship, look at how the way it trade, there is always what we call a premium and a discount between the palm oil and the soybean oil market. Now, if you are looking at to trade this particular relationship, you can look at the spread between these two prices. Now, on average, the spread between these two commodities, usually soybean oil is traded at the quite a good premium compared to palm oil prices. The premium is about $150 on average. This has been over the past 10 years or so. Now, since the pandemic, I think crucially at the start of the Ukraine and Russia conflict, we saw this relationship start to take a tear, where I think bean oil at one time it traded at a steep premium compared to palm oil, or rather palm oil was a heavily discounted. I think was trading about $800. And since then, I think the average has actually been narrowed. Now, in fact, I think we are trading below the historical average of $150. So what this means is that is crucial to determine is that how are we going to react? Especially when you have a lot of discount that's coming to the market, especially for the bean oil market, is definitely going to impact the palm oil prices. Indirectly, it's telling you that the palm oil market is definitely not cheap, and bean oil looks comparatively cheaper. So, in a sense that if you look at on the bigger scale of things, it's more viable for people to buy soybean oil rather than palm oil, given that the discount between both markets are very narrow at this point in time. Now, if you just look at this spread, it's clear to say that there's not much of upside for palm oil. In fact, there is it's cheaper for traders to looking at the bean oil market rather than the palm oil market. So this is a relationship between both the spread dynamics between the palm oil and the soybean oil market. Now, the reason why I mentioned is that to look at palm oil and soybean oil, if you just look at how you quote the movement between the two commodities, you can see that they're quite parallel in a sense. These are usually during the Asian hours where it's being heavily traded. So it's not fair to say that during Asian hours, bean oil is being a US commodity, so therefore it's lessly traded or it's not active. It's not the case. If you look at most times, when you compare palm oil active hours during the Asian hours and you relate that to the soybean oil market, you tend to see a lot of movement that's happening in place. So in a sense that there is movement between both commodities, and it can get quite active also especially during the Asian hours. Now, I think the second part is talking about weather. Weather is very crucial in a sense that it can impact prices in a very drastic manner. Now, there's two weather extremities. One is El Nino and one is La Nina. El Nino is more of a concern because it associates with dry weather. Now, when you have a dry weather, the impact on your crop is bigger. Wet weather is more towards, there's more flood, there's more plantation that's more prone to flood. So therefore, it hamper your harvesting activities. But when you have dry weather, your production will definitely get impacted quite badly. So La Nina, obviously, when La Nina is associated with more wet conditions, that means there's more flood happening in certain key plantation areas. Like El Nino is a different episode. It's related to more of a dry weather situation. And market is reacting more towards El Nino phenomena. But having said that, not to say the market is discounting a La Nina event, but when there's a weather extremities or when there's a confirmed occurrence of a weather extremities like La Nina, normally prices will tend to react. So I think this is where weather can be a very dynamic play. Now, if you are trading the US market, you know that weather is a crucial factor. Weather can take a turn in a sudden 360 in a period of time. So that's where it's crucial for us to always watch out on weather report. Now, I think the latest weather report is indicating that probably as towards the third and fourth quarter, we are going for a weather extremities, which is a La Nina event. That means there's more flood activities, especially in the key plantation areas that will hamper harvesting activities. In that sense, means production will be affected. So let's see, I think whether this will materialize. If this materialize, that usually have a toll on prices. So if you are trading the market, you have to be aware of weather extremities events like this. So now I'm not going to go too much on what La Nina event will entails. You can obviously go and Google it. But normally that usually means there's more weather conditions in certain parts of the key plantation areas in Malaysia. So that means usually production will tend to be affected. But it's not as much as having an El Nino event where it's associated to drier conditions. Now, drier conditions will have a much bigger impact when it comes to the production effect. Now, this is looking at production, palm oil and crude oil. You can clearly see there's again a positive relationship. That means high oil prices normally benefits the palm oil prices as well. Reason being is because high oil price, there's more incentive for people to blend palm oil with crude oil as biodiesel. And when oil prices starts to plunge, there's no incentive. As simple as that. So right now, I think oil price at this point in time is still considerably quite high. But as crude oil prices tends to go weaker, it's going to put pressure for palm oil prices as well. So I think that's where we really need to be careful with, especially looking at the palm oil and crude oil dynamics. So again, I think government will have a play in terms of factoring policies. So here you can see that Indonesian government is thinking of doing the B40 rollout, which means that's 40% requirement for biodiesel. This is a lot. And eventually that means higher demand for palm oil, and that will push prices higher. Again, these are all trial that's not confirmed or it's not mandated by government. As long as it's not mandated by government, there's always it's based on people's incentive. So if oil price remains low or not sufficiently high enough for people to switch, you don't see prices going higher whenever or rather biodiesel demand is going to get better. Now things will change with oil prices getting higher. If oil price spikes to above $100, that's where I think people will start to look at less biodiesel demand, because as long as prices are remain relatively low, there's no incentive. Eventually, biodiesel demand is just an added bonus when it comes to demand. The real proper demand still comes from your normal food consumption, and especially from big countries like China and India. So biodiesel demand is pretty much a crude oil play, and all depending on where oil prices is going to hit. Now, this is looking at ringgit against ringgit relationship against the CPO prices. You can see that a weaker ringgit normally means stronger. There's more demand for CPO, because right now, if you are a US buyer or US consumer, whenever you are faced with weaker ringgit or rather a stronger dollar, that means you can purchase more of a CPO as on the ringgit weakness. So in that sense, whenever you have a weaker ringgit, normally it means that it's usually beneficial for CPO prices. But when you have a stronger ringgit, normally it tells you that there's less competitiveness when it comes to the ringgit denominated CPO contract. So in that sense, demand will be affected. So that's what we are seeing right now in the past couple of days. We see ringgit strength strengthen a lot considerably, and that actually take a toll on possibly the demand for CPO going forward. And eventually price will react. That means when you have high or rather you have strong ringgit performance, it will actually be a downside for CPO prices. So I think ringgit factor can play a crucial role, especially when it comes to the demand factor for the CPO market. Now, impact of government policies, I think this is pretty much something that's not easy to predict. And in fact, government policies can come in it may not be on a regular basis, but the impact can be quite considerable. I think this happens especially during height of a crisis. I think this, if you recall, I think back in 2022 when you have the Ukraine-Russia conflict, you can see that Indonesian government decided to do or to restrict palm oil exports. When that happens, prices of CPO just jump almost 1,000 ringgit in a matter of days. Reason being is because once Indonesia banned their exports and they're not able to export out their palm oil to other countries, the only avenue is Malaysia. And with that, the demand will just jump. Because of Indonesia government policies, actually affected the price market for the Malaysia palm. So in a sense, I think government measures tend to have quite a considerable impact. And this, again, we can't really predict. And as a trader, we really have to be very sensitive when such decisions are announced. If the position is against you, we have to be out of the market quite fast. Now, I'm not going to go too much on the EUDR requirements. Basically, this EU requirements on pretty much on whether it's Malaysia or Indonesia's source of palm oil. Pretty much is talking about the deforestation or rather decarbonization impact of the plantation. But having said that, I think EU is not much of a big effect when it comes to, or rather a big major player when it comes to Malaysia palm. But nevertheless, this will have policy consequences on other countries as well. But do keep in mind, these are all government policies. Eventually, will have an impact on prices as we go towards a medium or longer term impact. Now, geopolitics again is, usually it does impact. Whenever it impacts commodity exporting countries, whether there's a tension in that region, it will definitely affect the commodity prices as well. So in this case, we saw that the height of the Ukraine-Russia conflict or the start of the Ukraine-Russia conflict, we saw there's a lot of uncertainty in the market. It created chaos in the market. In fact, I think CPO market during that period of time was very volatile. The daily range in a particular day was easily between 200 to 300 ringgit per ton basis. So that's quite substantial. And usually this happens when geopolitics is in play. Now, obviously, right now we are faced with a lot of headwinds. We have obviously a lot of geopolitics tension that's happening. So all these dynamics can eventually affect the market as well. So be on the lookout. If you are trading the CPO market, these are the things that we have to be careful and watch out for. Now, this is what I meant by seasonality. So if you look at CPO prices in general, over month-to-month basis, we tend to see there's always a period where prices tend to be weaker and there's a period where prices tend to be stronger. So if you do the breakdown accordingly, over the past 2 decades or so, we can clearly see that, if you break down the performance month-to-month basis, the beginning of the month and the beginning of the year and the end of the year are usually periods where you tend to see more positive prices. That means month-to-month change tend to be more positive. Why is that so? If you recall back in your beginning of the presentation I showed to you on the productions slide as well as the stock pattern, you notice that production in the beginning of the year tend to be very weak, and also the end of the year. This coincide with holidays and whatnot, so we have shorter harvesting period. Now, if you look at this table again, if you notice that the periods between May to August or even September, August are usually quite a mix, but June, July, August are pretty much bearish months when it comes to prices. So if you recall back, if you relate back to your production seasonality, these are the periods where you start to see prices tend to be higher, production tend to be higher. So therefore, prices tend to be weaker. So because of this pattern that we can see is this seasonal pattern that's in play, we can roughly deduce that which are the period that is good for you to take a long position and which are the period that is good for you to take a short position, based on the pattern of the seasonality pattern. So going into the second part, I think once we understand or once we identify factors that's actually attribute to the price performance, now we can obviously make our entries and exit more precise by looking at the technicals perspective. And one of the ways is to look at certain technical tools that's available for us to judge trend or to gauge trend in the overall market. So I think these are pretty much a plan that you can use to set up a particular trading strategy. I think first thing is to identify the trend. So if you're a trend trader, trend is matters the most for you to the market. So if the market is telling you that the trend is on longer term is a bullish market, you should be finding position for it to long rather than short. If the market is telling you on long-term bearishness or short-term bearishness, find a position for it to short rather than long. So trade according to the trend of the market. And the first thing you need to do that is to gauge where the trend on the market is. There's always tools that's available that you can look at. I think one of the easiest way is to plot moving averages and to see where the price is in relation to the moving averages, and from there you can probably see where the trend on market is. Or rather, you can use the second method is to use a Heiken-Ashi to assess the shorter term trends, whether the short term trend is it bullish or bearish. Heiken-Ashi is slightly different from Japanese candlesticks. Is derived from Japan's candlesticks, but slightly different because Japan's Heiken-Ashi takes the average of the bars. So in a sense, it paints a better trend picture as compared to candlesticks, which is more of a reversal by nature. And you can obviously incorporate other tools like moving average crossover or directional moving index as a way to measure the strength of the trend. Last but not least, in every trade setup, you need to have ways for you to get out of the market in case you are wrong. And I think one of the great tools is to use what we call average true range. Now, average true range is a measurement. It's a measurement of where the daily range are or where the period range are, and we base on that daily range to set our profit target and the stop loss levels accordingly. And always, last but not least, we always end it on a daily basis to always track and measure your trading performance. Regardless whether it's a down day or whether it's a profit day, having a basis of measurement keeps you on track to see whether you have actually, you identify areas where you can improve and identify areas where you can enhance or expand your strength accordingly. Now, first thing is to look at the overall trend on the market. You can clearly see the CPO market is still pretty much on a sideways market for the last couple of months. Now, the last 2 days was very crucial because of external factors. We see the sell-off in equities market. It actually overspilled into the commodity space as well. You can see that we finally break below the crucial support. In fact, I think the short-term trend on the market is still showing you a downtrend for the CPO market for now. There's no sign of reversal. In fact, don't try to time the reversal unless that the market shows strength that it try to break above the downtrend or the downtrend starts to get weaker. That usually be the first sign. Wait till the trend shows you there's a determined trend that's going to turn, then only you position yourself. But I think for now, looks like the market is still on a short-term downtrend. Now, the reason I mentioned about Heiken Ashi is just, if you just look at it, Heiken Ashi and Japanese candlesticks. So the chart on the left is Japanese candlesticks. You can see that, if you compare Japanese candlesticks and Heiken Ashi, the bars are on Heiken Ashis are clearer in the sense that you can see the uptrends and downtrends in a much clearer fashion. Japan's candlesticks, you can't really see that because if the markets are doing range, you tend to see a lot of whipsaws. So if you use Heiken Ashi, the calculation of Heiken Ashi is using the average bars of the Japanese candlesticks, so in a sense that it signals a trend, or rather you be put in a trend on longer term, and you won't get stopped out that easily. So as long as the candles are showing you green, that means the market is still heading higher. If the candles are showing you red, that means the market's on a downtrend basis. And the length of the candle shows you something. The length of the candle shows you the strength of the trend. So as long as the candles are, the body of the candles are wide and long, that means there's momentum in the strength of the trend. So if you are holding a particular position, you should be still in the market until the body of the candle starts to get smaller, and that's where the momentum starts to get weaker. Japan's candlesticks now is more of a reversal type of pattern in nature. So it's very hard for you to time, for you to use it as a trend analysis. So just to show you the dynamics, here you can see if you pair with moving average crossover, you can pretty get quite a good signal. So one of the ways is to pair a short-term and longer-term exponential moving average. So what we have here is that you can see all the green bars. So when the body of green bodies are getting wider, that tells you there's a strong bullish momentum. And bullish crossovers are simple. That means when you see a bullish crossover, it means the shorter term EMAs is crossing above the longer term. That means it's bullish scenario. When that happens, that means the market is poised to go higher. So two signals. Once you have green Heiken Ashi bars, you have a bullish crossovers on EMAs, pretty much is a good entry for you to take a long position. Now, vice versa, if you start to see red candle bars and these red Heiken Ashi candles are white, that means the market is actually quite bearish. And when you start to see a bearish crossover, that means the shorter term crossing below and the candles are below both the moving averages, it tells you the market is pointing lower. And usually this is a good entry for you to take a short position because of the bearish crossover. Now, I just want to incorporate another tool which is called Directional Movement Index, DMI for short. Now, DMI, the main use is actually to gauge the strength of the trend. So first thing, once we identify the trend, is try to position a trade based on a trend. And it's important for us to gauge the strength of the trend. We don't want to be entering a trend where the trend is really getting weaker. So because when that happens, that means there's not much of an upside or downside anymore. So importantly is that we also need to measure the strength of the trend. And one of the ways is to look at the DMI tool. DMI also can seek to measure the strength of the trend. Now, DMI has three different lines here. We have the red line, which usually means the minus DI, negative momentum. The green line is positive DI, which means positive momentum. The black line is ADX. Now, the ADX, the black line, is crucial in a sense that it actually measures or is actually gauge the strength of the trend. So you can see here, this period here, when you start to see the black line rising, this is coincide with a period where the market is going on a downtrend and downtrend is gaining momentum. So same goes for here. We have a positive crossover. You can see that the positive, DI, the green line is crossing above the red line, and the black line, the ADX line, is rising. That means this bullish trend you are seeing is actually getting stronger because of the ADX, the rising ADX value. So this, in a sense, that is actually DMI help us to gauge the overall strength of the trend. So if the trend is strong, normally there's still room for us to write the trend accordingly. So if you take out both the red and green lines, which is the minus DI and the positive DI, you can just leave it out with the ADX. You can see how that is measured against using ADX to measure the strength of the trend. So whenever there's low ADX value or ADX is coming down, that tells you the market is heading nowhere. There's no, or rather the strength of the trend is getting weaker. Once you see that, you should be out of the market. So what we have here is that the market is moving sideways, the ADX value is falling. That means the market is heading no direction. During this time, if you're using trend trading strategy, you tend to be getting whipsaws. So it's important for you to understand that are we in, which are the period are we entering into a trending position. So importantly, by then you should gauge your positions. So here we have also again a bullish crossover. You can see the ADX value is rising. That tells you that the market is generally going higher. So ADX is a good measurement for you to measure the strength of the trend accordingly. So putting all that into perspective, how do we do a trade setup? It's simple. I think first thing is to identify the color of the Heiken Ashi and the Heiken Ashi candles itself, coupled with the moving average crossover. So if we have red Heiken Ashi bars, and the bars are very wide, and you have a bearish crossover and moving averages, this is a good signal for you to take a short position. Now you do notice that the crossovers on the DMIs are also very similar, giving you a similar signals when you use the moving average crossovers. So in a sense, it's quite overlapping. Now you can in a sense that you can use both, but importantly, the DMI tool is for a reason for you to measure the strength of the trend. Now you can see here why is this a good setup is because the ADX value, which is the black line here, is rising. Is telling you that the downtrend is actually gaining momentum. Now, with that, I think it's important for once we identify the trend, it's important for us to set a particular target profit and stop loss level accordingly. And how we do that is to use the ATR value. Now, ATR value stands for average true range. That means it measures the true range of the particular period. So in this example, on this CPU example, is the ATR value is 24 points. So if you look at it, the way to set up your profit target and stop loss level is once you have a signal for you to take a short position, so you short a particular price and the ATR value at that period is 24 points. If you work out on a reward to risk ratio of 2 to 1, that means you are setting a profit target of 48 points of profit and 24 points of loss based on a 2 to 1 reward to risk ratio. So you work your risk accordingly based on the ATR value. Now keep in mind, if ATR values goes considerably higher when markets are volatile, that means you're prepared to have a bigger buffer for your loss position in case the market go against you, because you don't have a too tight of a stop loss where whenever market goes in a whipsaw situation, you tend to get stopped out quite frequently, and that will cause a lot of commissions or slippages involved. So you don't want that condition to happen. So be prepared when ATR values goes higher. That means the buffer for your stop loss is going to be bigger. So I think this is basically showing you, your short levels are the red line, your black levels are your stop loss level, and your green levels are your profit target levels. So how do you work that out? It's based on your ATR value. Now, just to show you another example, so you can see here the CPU, another CPU example is another trade example. You can see the red Heiken Ashi bars with a bearish crossovers on your moving averages. That tells you the market generally is going to hit lower. And true enough, you can see that here the minus DI is crossing above. That is technically a crossover on your even a DMI indicator as well. And the ADX value is rising. That tells you the downside momentum is going to be heavy. So it's a good signal for you to take a short position. So again, you work on the ATR value to use that as to determine your profit target and your stop loss level. So this is what happened once you have established your profit target and your stop loss level accordingly. Okay, I'm just going to go to the third part, which I think is these are the third technique that you can look at when it comes to trading the CPO market, which is not much mentioned, but I think it's important for us to look at as well. So I think first part I covered on looking at things on a fundamental perspective. Secondly is to look at things on a technical perspective using trend trading strategies. Third, I think you can obviously trade the market using spreads as well. Now, spreads are not that complicated once you understand the functionality of it. It's highly functional. If you talk about risk, it's definitely lower risk compared to trading positions as outright. So a lot of examples I showed to you earlier, those are what we call trading on outright contracts. and those are you have a heavy risk exposure. When you trade spreads, you are taking long or taking short positions, and the other positions you are also taking simultaneous opposite positions. So in a sense that you actually minimize your risk quite substantially. Now, I don't go too much on spread trading, but I think it's important for us to look at spread in a sense that, because of the nature of lower risk, it's actually quite beneficial when it comes to a very volatile market situation. So if you can't, if you find that trading outright positions are very volatile in nature, it may affect how you trade on your spread basis. So I think spread is actually more beneficial in the sense that it gives you a bit more advantage and lesser volatility. Now, there's a lot of type of spreads, but I think the main focus in this session is talk about the calendar spreads, which is talking about the 2 different months that's listed on the futures market. So example is that you do talk about a calendar spread will be a September CPO contract against a December CPO contract. So you're looking at a September and December contract simultaneously. So you can obviously take a long or short position on one contract and the other opposite position on the other contract. In a sense that your risk is actually square off. Ultimately, you're only looking at a price differential between these 2 listed contracts. Now, there's always a lot of basis why you want to execute a spread. I think main thing is about your view of the market. If you see that a particular, for example, the current active month is October against the next month, the November, next active month, the November contract, you probably think you have a view that the October contract is going to move faster. So that means you're actually quite bullish on the October movement, and you're actually quite bearish on November. That means this particular spread on October, November is going to be quite bullish. So you'll be probably taking a long spread position. So ultimately, the view of taking a spread position, it determines by how you see both the calendar months are behaving. How do you see that, whether the October is moving faster or whether the November is moving faster, vice versa. So that's how you actually position your trade accordingly based on the spread market. So when to be bullish and bearish, I think it all determines on how you see the both intermonths compare. If you start to see that October is more bullish, is because you start to see there's more fundamentals factor that's going to affect October rather than November, and that's going to push October prices higher. That means you're going to be quite bullish on the October-November spread. Now, vice versa, if you start to see factors going to affect October rather than November in a negative way, then you should be shorting the October-November spread. For the simple fact that October is going to be more bearish compared to the November contract month. So bull spread is always a scenario where if you're looking at September, or for example a September and October contract, when you're bullish on a particular spread, it means that you're very bullish on the September month as compared to the October month. So therefore, you're actually looking to long September and to short the October month, given the fact that you are looking at more bullishness in the near months as compared to the further months. Now, bear spread is the vice versa, is a reverse scenario that you're looking at prices on the nearer months to be more weaker, more bearish as compared to the further months. So therefore, the spreads will eventually narrow. That means you are shorting or doing a bear spread on the market. Now, benefits of trading spreads as compared to outright is definitely on the risk. Outright is you're exposed 100%. If you are doing spread, because of the nature of you holding 2 opposite positions, you are actually getting you are facing lesser risk. Now, margins requirements are also very different. Margin requirements is higher for outright positions. Usually for spread, margins are usually lower. So therefore, you are able to manage your risk even better because of margin requirements, lower margin requirements. And now, a lot of people say that the way to trade spreads, you can't use technical. I think that's far from the truth. Whatever I mentioned earlier on when you talk about trend trading strategy, using Heiken, Ashi, using moving average crossovers, you can also apply the same thing on the spread market as well, on the spread chart as well. In fact, I think in trend trading tools, spreads are more trend behaving as compared to outright. Outright, it tend to get a lot of swings. Sometimes the market may move higher, sometimes the market may move lower, but spreads tends to show you a better trend as compared to outright positions. Now, seasonality impact is also critical if you're using spread, because it does tells you, if you look at certain months where periods, certain months are strong, certain months are weak, you can actually use the spread to reflect those positions. So in a sense that spread can also help you to reflect certain seasonality impact in the market. Now, I won't go too much on contango and backwardation. These are all jargons, but what it means is that if the market is contango, it tells you that the further month prices are higher. So, for example, right now it's October. If you compare, if the market is contango, that means the November contract is going to be higher than your October contract. Now, normally this is a normal market, but right, there's a cost of carry. So, contango market usually tells you that generally the market is usually quite at the current moment is actually quite bearish. Now, backwardation is a reverse. Backwardation means that the forward months is lower or future months is lower in terms of prices. Now, this usually happens when the market suddenly becomes very bullish. If you notice, when the market is short in supply, there's a sudden supply shock, the market will quickly behave from a contango to a backwardation in quite rapid manner. We have seen that a couple of times, and these are also signs that is telling you that the market's expecting or the sentiment has changed, that the near month is going to be very bullish. So therefore, the market is in a backwardation market. As we go into further months, price will tend to be weaker because supply is coming into the market. So we always view this is that contango is normally quite a bearish play because it tells you that the current month is abundant in supply. Backwardation is more of a bullish play. It tells you that the current month is short in supply, therefore the price is higher compared to last month. The futures months. So backwardation, right now you're seeing the market is pretty much a backwardation market. The forward months, the future months are actually trading lower. So it tells you that as we go forward to the next couple of months, production is going to come back, supply is going to be better, demand is going to be weaker, so therefore prices will have to come down. So that's one way of telling the sentiment of the market. So these are the list of the CPO futures contract. You probably can get it on Bursa Malaysia website. They are all available. One good thing about doing spread is that you can pair a particular month with another particular month that's listed on the exchange. So for example, here October is an active contract right now. You can pair October with January 2025 contract. You can do that kind of spread. Again, most important thing to take note of is that there is seasonality impact in play in this kind of months. So be important to take note of the seasonality impact. And it's important that if you are looking at a particular price differential, the price differential can be wide when you compare with further months away. So the movement can be quite volatile. And as we go further out into further months, you notice that the volume tend to be lesser. So if you are doing a spread on that particular pair, you have to prepare that when volumes are low, normally it tells you that the spread or the price it won't be that efficient or efficiently priced because of the volume that's involved. So these are list of calendar spreads. So as I mentioned, we always look at the heaviest volume, which is usually entails the active contract. So right now the active contract is October. So October, November calendar spread is heavily traded at this point in time. Now, obviously, August is a spot contract coming soon. Normally, the volume will get lesser each day as we approach the spot months. So it's important to look at the active months calendar spread because usually that will have the highest volume and that gives you a lot of liquidity. Now, as I mentioned earlier, currently the market is in a backwardation mode. That means the further months are trading much lower prices. It's telling you the market right now is pretty much still a short in supply situation. Now, I don't want to go too much on spread dynamics, but what this is telling you is that the market curve is forward months or rather future months are quite lowerly priced or quite negatively priced. So it's telling you as we go into the next 6 months or so, supply should come back into the market. Now, the key thing is to watch out is that if there's anything that's going to happen in the next 6 months or so, whether it's a weather play, whether it's government policies impact, it will change the curve. And when that happens, you start to see the spread dynamics starts to change. Normally, that tells you probably there's a change in trend as well. So if you are looking at outright prices, you're looking at charts, when sentiments change, when market change from a backwardation to contango market, it tells you something. Usually it tells you something. So I think it's importantly for you to always on and off look at where the dynamics of the market in terms of the future contract prices is, right? So applying technical analysis on spread chart is also very similar on applying the same thing as applying on the outright basis. In fact, you look at it, the trend spread tends to trend longer term. That means when you start to see there's a confirmation that the spread is going to go bullish, it will tend to be bullish for quite a while. And unlike outright, you tend to see there's bullishness on one day, then suddenly the market take a turn. So you can clearly see this is a very strong bull trend, given the fact that you start to see green Heiken Hedgie bars. There's a crossover. The DMI also confirmed that rising ADX value tells you there's strength in this uptrend. And it actually trend for almost, I think, more than a month. So spread itself, once it trends for quite considerable amount of time. Unlike outright, where it can change, the views can change in a matter of minutes or even hours. So this is an example of trading a spread chart. So here you can see green Heiken Hedgie bars. Now one thing good is also looking at volume. Now if you look at the uptrend and the volume is sustained by heavy volume, it tells you the uptrend has momentum, has strength. If an uptrend doesn't sustain by volume, that tells you that the uptrend is going to be weak. You need volume as a sign of confirmation that people are participating in the uptrend rally. Now, DMI is also indicating that rising ADX and there's a positive DI crossover. It tells you there's a good long signal here. Now, ATR value, if you use ATR in Heiken, in spread charts are in a way quite less relevant for the simple fact that spreads are less volatile. Now, you look at this ATR value, you're talking about only 1.5 points movement on this period of time, and these are 30 minutes time frame, which is quite considerably quite long. So in a sense that if you trade spread, there's less volatility. Now, doesn't mean that you can't use ATR. You still can use ATR as a gauge, but obviously you can look at other means of assessing your profit target and stop loss level. But the simple principle still remains. You still need to have a way for you to get stop out in case the market go against you. So you still can use ATR, but be prepared that the period that you use the ATR value may not be significant because spread doesn't move as volatile as outright basis position is. Now, this is basically my view on where I see CPO outright prices going to go. Now, if you look at it, we just broke out from a heavy long or rather sideways channel for quite some time. And I think, in fact, the market is going to hit lower given the fact that soybean oil prices is not showing you sign that is the downtrend is showing you sign that it's going to the strength is going to be abating anytime soon. So as long as soybean oil continue to be weak, it's going to be pressuring for CPO market as well. Now, if you look at technical chart per se, the 3,600 ringgit, this is continuous chart. That means right now it's showing you October contract month, which is the active month. The 3,600 is crucial to support. If it breaks that, that means the market is going to hit even to the next level. But I believe it will hold for the fact that, I think if you look at where the dynamics is, despite seeing rising production, the stock levels are not inching that much high. They're still below 2 million tons. It's a sign, it's a good sign. And as we head into the third quarter to the end of third quarter where production tends to be weaker, if stock levels are not going any higher and start coming down, we should see prices to rally one more round. So the way I look at it, I think 3,006 is a very strong support. But I think right now we probably will face a lot of headwinds from external pressure, mainly because of soybean oil market, and also mainly because of bearishness in the external front, the equity space and whatnot. So I think the 3,009 is something of a crucial resistance level to really, if you want to break that, then probably we could see the price to rally to another level. But having said that, I think price right now still points to a weaker momentum. It's true indicative to the DMI, the ADX value is starting to rise. That tells you there's still some leg for the market to go lower. Until then, where ADX starts to decline in value, we start to see where market tends to go sideways. I think to conclude, I think first thing is that the first technique to really look at is to look at things on the fundamental per se. Now, trading CPO is actually quite fundamentally driven. As I mentioned earlier, we have the monthly MPUB report, which is very crucial. It tells you the demand and supply dynamics of the market. You can't run away from that. If the market is oversupply, you don't expect prices to go up. If the market is under supply, stock levels are coming down, there's no reason for prices to come down. So that's important for us to establish our view of the market based on the fundamental information. Second thing I think is if you're a trend trader, trade with the trend. That's one of very good advice. I think secondly is to use trend trading tools like Heiken Ashi and moving average crossovers. These are all sufficient enough. And obviously you need to back test against the period that you're using. And this is, I always get this a lot. People always try to time the reversal of the market. Now, timing reversal market is never easy. So if the trend is up, find positions for it to long rather than short. As simple as that. Trade with the trend. Now, thirdly, I think spread trading, a lot of misconception in the sense that is people say it's highly sophisticated, it's too difficult to understand. Now, once you get the hang of it, once you understand the nature of how it works, and once you can apply technical tools to study the spread chart itself, it's actually quite easy. In fact, when you talk about risk exposure and the margin requirements, it's actually very efficient. So therefore, I think spread trading gives you a lot of edge and benefits if you are trading a palm oil market. And last but not least, you are doing this full time. It's importantly for you to always review your performance on a daily basis to gauge your overall performance. So I'm just going to end here with just a quote. This is from Exakota. So you understand that markets these 2 days are very volatile. And time to come with so much external headwinds that's in play, volatility on market is going to be here to stay. And when markets are so volatile like this, there's always one good rule to always keep you alive is to cut your losses fast. So what he mentioned is that if you can't take a small loss, sooner or later you will definitely take the biggest loss in your career, and that could be ending your career if you're taking trading as your full-time career. So with that, I'm just going to end here. I just want to pass it to Siva if you have any questions from the audience.
Much, David, for your informative sharing. I'm sure our audiences here have gained a lot of valuable insights into the 3 comprehensive trading techniques for trading the CPO futures. It's now time for our Q&A session. So if you guys have any questions related to David's sharing, please type them in the Q&A box so that I can easily capture and address them. While we wait for questions to come in, I would like to ask a small favor from you. Please take a minute to fill out our feedback form since we have provided an informative session for today. It will take you less than a minute to complete. You can find the feedback form in the chat box or you can scan the QR code with your smartphone. So just take a quick minute to share your feedback. It will greatly help us improve our future sessions and ensure we continue to deliver a valuable content that enhances your learning experience. So please take 1 minute to complete the form and we will begin the Q&A session shortly. Another 30 seconds to go. All right, 1 minute has passed. If you have already submitted your feedback, thank you very much. Well, for those who haven't finished yet, you can continue to do so. Now let's move on to the Q&A session. Now, David, are you ready for some questions that is posted by our audience here?
Yeah.
Now, the first question, David, earlier you shared about looking at soybean-related products. There is one participant asking that which soybean futures to look at because in the United States there are several soybean futures products.
Yeah, I think that's a good question. Thank you for the question. I think the one that's mainly relevant is U.S. Soybean oil the active months, which is I think right now is the November month is very relevant. Always look at the active months. And obviously there's also other soybean byproducts, which like soybean meal or the core soybean product itself. Those also have a bit of relevance. Soybean meal is less relevant to palm oil. Palm oil direct relevance is always the bean oil, because it's almost a direct competitive product. Soybean is the core product. Sometimes the performance may affect, sometimes it may not, but it's more relevant to compare the soybean oil with the palm oil market. And in the comparison is always to draw the active soybean oil contract with the active CPO contract.
All right. Another question, which is also fundamental related, which geopolitical tensions, for example, like the Middle East tension, whether does this kind of tension affect CPO price or not?
It does to a certain extent, but it's not a direct impact. It's impacting, as long as impact crude oil massively, when crude oil spike up, then it will definitely have impact on the palm oil market. If I recall on the previous slide, showed to you the relationship between the palm oil and the palm oil and the crude oil slide. You can see that whenever a high oil price environment, normally that will support CPO prices as well.
Okay, another question, I think it's related to Heiken-Ashi candles. Earlier you shared about using this kind of chart to look at the market. Where can we get the Heiken-Ashi candles? Whether do we need to subscribe to any charting platform?
Okay, I think this question you can, if you're already having a futures account, you can probably approach your broker to ask for it. I think at most major brokerage trading platforms, as long as they have chart available, they do have the Heiken-Ashi chart options as well. But a lot of my examples are coming from Bursa Station and TradingView. If the audience wants to know where I get my chart from, and those platforms will have Heiken-Ashi candlesticks available.
All right. Another question also related to Heikin-Ashi candles. Which time frame is actually more suitable for applying Heikin-Ashi?
Okay, I think in most examples I shown to you the trade setup example, the time frame I'm looking at is actually 30 minutes. Now, anything short in 30 minutes for CPO market, and using Heiken-Ashi, you get a lot of whipsaws. Sometimes the candles can go from green and red, and it can go sideways. So you don't get much of a signal. 30 minutes is just ideal. Now, obviously, in quiet days when the market is ranging, you don't see much of a signal. So then you can go on the external, on the longer time frame, probably an hour or 4 hours or so. But I think 30 minutes time frame is a base of it.
All right. Another question. What is the recommended time frame for spread trading?
Now, spread trading, normally you deduce the analysis, time frame analysis, from a longer to shorter term. So the longer one you're looking on a daily basis. So usually you look at the daily Heiken-Ashi. The daily Heiken-Ashi points to you is still on the uptrend. Then you go down to a lower time frame. I think the lowest time frame you can also use 30 minutes. Now anything below 30 minutes, again, you get a lot of whipsaws. So I would say from a daily, bring it down to a 30 minutes time frame for your entry.
Okay, while we are still on the topic on spread trading, there are so many spread contracts. So, which spread pairs that can retail traders would be preferred for trading?
Okay, that's a good question. I highly recommend that only use or only involve contracts that is active. So right now, the active contract in CPO market is the October contract. So look at the October spread pairs. So you can look at October, November spread. You can look at October, December spread. You can look at October, January spread. As long as the third month active. The reason is because there's volume. You don't want to be looking at spread pairs where you have less volume. That means your slippage can be quite high. So look at spread pairs that has volume, and usually that volume is always centered on the active contract months. So in this case, it's October pairs.
All right. There is one question I think I believe it's somehow a little bit related to the fundamentals of the market. The question goes like this: How will a big stock market crash might affect a CPO futures market?
Well, whenever we have an external environment, external shock, as well as seen on Monday or yesterday, you can't run away. If it's a sell-off across all commodities, palm oil will definitely be affected. But I think factors affecting, like just now, one question posed was like, what happens on the Middle East tension? That how would that affect the palm oil market? Now, in that reason, that is affecting the crude oil market. So in that sense, once it's affecting the crude oil market, it's also affecting the CPO market. So how it relates is that when you have a big external shock in a market, it's gonna spill over to the palm oil market. But I think those direct impacts like crude, like palm oil, or no, like crude oil and soybean oil, factors, those are much bigger impact that can really drive palm oil prices.
All right. Due to time constraint, we are going to take one more last question. Now, David, can you briefly summarize what are the key fundamental factors that is actually very important for a person who is trading the crude palm oil futures?
Okay, I think if you ask me a few key factors, I think firstly is that we can't run away from supply and demand, S&D. It's as simple as that. So if I mentioned, if a market is oversupply, there's no reason for market to go higher, for prices to go higher, and vice versa. If the supply is limited, there's no reason for prices to go down. In fact, prices will climb higher. So the key factor is always look at supply and demand. Second thing I think is to look at the bean oil performance, which is very heavily reliant on the palm oil performance as well. So I think there's a lot of external factors. I think bean oil is one of it. Crude oil to a certain extent. Ringgit less of a extent, unless it's a very big movement in ringgit strength that can really sway the demand factor. So again, I think if you really want to deduce it, the supply and demand, you can't run away. External factors like bean oil and crude oil, those are also very crucial for palm oil price performance.
All right. Thank you very much, David, for answering our participants' question. And for audiences, please understand that due to time constraints, we may not be able to address all questions. So now it's not time for me to conclude today's webinar session. Now, once again, let me remind you for our upcoming webinars, especially for those of you who may have missed the earlier announcement. The LRF Let's Learn Futures webinar series featured a variety of topics scheduled every Tuesday evening from 8:30 p.m. to 10 p.m. We cover a wide range of content-packed and informative topics where you can gain a practical knowledge about futures trading from our experienced speakers. So if you're interested in joining any of these sessions, you can scan the QR code to register for the topics that you would like to attend. Once you scan the QR code, you will be directed to a page where you can access to our event calendar. So to join our upcoming sessions, simply navigate to the Tuesday column on the LRF webinar topic section. So click on the session that you're interested in and proceed with your registration accordingly. In addition to our webinars, we also offer the LRF online workshop. These workshops is tailored for those who are new to the futures market. So if you're new to and interested in learning about futures trading in detail, then this online workshop is ideal for you. So you can take a picture or screenshot of this page and register yourself after this webinar ends. And feel free to share this event with your friends and family who are also interested in futures trading. Because in this workshop, we will guide you step by step on how to start trading your first futures contract. And please note that each session is limited to the first 50 online attendees. So be sure to register yourself quickly to secure your seat in both workshops. Once you scan the QR code, again, you will be directed to a page where you can access our event calendar. To find the LRF online workshop, you can look for them in the Saturday column. So you can click on the workshop session that you're interested in and proceed with your registration from there. Bursa Malaysia hosts a website called Bursa Marketplace where you can explore a derivatives trading simulator. This simulator allows you to engage in paper trading. It will help you familiarize yourself with using a futures trading platform. So you can register for a risk-free trading experience and give it a try to start developing your interest in futures trading by using this DTS simulator. It's a great way to learn and gain hands-on experience through this simulator. Finally, before we conclude today's webinar session, allow me to introduce you to Bursa Academy. Now, this Bursa Academy is a comprehensive one-stop e-learning platform where you can access all the information and knowledge about stocks, futures, and other products traded on Bursa Malaysia. You can access a Bursa Academy by scanning this QR code on your right or by searching for Bursa Academy on Google to find the link. You can visit this site for more detailed information and resources. It's a valuable resource to enhance your understanding of the trading products in Bursa Malaysia. All right, we have come to the end of our webinar session today. Thank you, David.
Thank you.
For sharing such an informative session with us. And to all of you who joined us today, thank you for your participation. We hope you find this webinar both informative and valuable. And I believe you have gained new knowledge in how to trade the futures market better. So with that, I'm CY signing off now, and enjoy the rest of your evening. Good night, goodbye, and until next time. Bye.